All right, here's a new ratio we haven't talked about yet for your analytics. Can I what? I'd love to go back one slide. How's that? Okay. Everybody good? Remember, the slides are available online on Blackboard. Okay. All right. I'm going to move over to this side of the board. Okay. So dividend yield ratio. This is a new tool that we're going to put in our arsenal. Think about this one for a second. If dividends are declared, the dividends paid per share divided by the market price per share, what does that give you? It gives you a return on your investment, right? So if you bought the stock for 20 bucks a share, you've got $20 invested. If you get a $2 return on that investment, you've just earned what percent? Come on, 10%, okay? So that's your dividend yield ratio. I just earned 2% on, or 10% on my investment. Make sense? I don't see anybody nodding yes or even no.
The dividend was just earnings per share.
No, it's dividend divided by the market price. Now notice, market price. You go look up in the newspaper or on the internet, what did it sell for today? Okay? It has nothing to do with par value. It has nothing to do with what you paid for it. It's what could I sell it for today? That's my investment.
The dividend is per share.
Yeah, so if the company declares a $1 dividend per share, that's your numerator, and your denominator is what's the market price of the shares on the exchange today. Okay? Will this number change every day? Yeah. Good?
So how is it a percentage of what we're earning on the investment if it's changing? If you're not losing the word investment?
Well, typically you only do it like every quarter or maybe once a year. Okay? So you're kind of benchmarking it through time. You know, this year I earned a 4% return on my investment. Last year it was only 3%. Hey, I'm doing better, right? It's like putting money in a savings account. If the bank is going to pay you 1% or the bank down the street is going to pay you 2%, which bank are you going to go to? So which investment do I want to make, right? Okay, everybody get the concept there? It's exciting. Don't fall asleep now. Absorb. All right. So, moving on. Sometimes a company will not want to part with their cash, yet they have a long history of paying out dividends. So they'll do something really cool. And instead of declaring a cash dividend, they'll declare a stock dividend. So instead of sending you a check that you can go to the bank and deposit, they will send you a new stock certificate. And if they do this, you know, say you own 10% of the company and they send everybody a stock dividend, you still at the end own 10%. The relative percentages of ownership don't change, because everybody owns just more shares, but the same percentage. The company didn't give up any cash, and stockholders' equity doesn't really change. This is kind of like the reverse of Treasury shares. You're putting more shares out on the market. Typically, when you put more shares out on the market, the price goes which way? More shares on the market. Down. Okay? So the shares might go down a little bit, but the concept is that maybe nobody will notice and it won't drop as much as it should, and therefore it'll make everybody's stock worth a little bit more. Or if there's more appreciation in the stock value, you own more shares. So you're kind of getting something for it. But the company, did they really give up anything? No. Not really. Par value stays the same. stockholders have the same percentage ownership. Okay? Now, as far as how the company records this, and here's the one that always tripped me up as a student. So we're going to go slow. There's two kinds of stock dividends. Not one, two. There's a small stock dividend and a large stock dividend. And the only difference it makes is how they're recorded. Okay? On a small stock dividend, that's when the dividend is less than 25% of the total stock outstanding. Okay? So if you've got 100,000 shares outstanding and you're going to issue a dividend of 10,000 more shares, that's less than 20%, right? It's a small dividend. But if we're going to issue a 2-for-1, we just now issued 100% more stock, right? So that's a large dividend, and you record them different. A small dividend you record at the current market value, right? So you've distributed retained earnings at market value. In a large dividend, you record them at par value. So let's do some examples.
So technically, for small and a large, like you said, the percentage doesn't really change.
No, your percentage of ownership in the total company does not change.
It's just how much they want to dilute their shares, I guess.
It's not really dilution because you own the same percentage. When you get diluted is when you...
Of each share, I guess.
Sort of. But typically the stock won't drop as much as it should because of more shares on the market. So they're kind of leveraging on people's behavior a little bit. Yes, sir.
Why do they have both the same values, 20 to 25%, less than 25?
One's less than and one's greater than.
Right.
Okay?
Yeah, 5% can go either way, is what I'm saying. It could be a small.
That's where,
large.
under GAAP, you're allowed to use your judgment to try and reflect the true activity of what went on.
How would that, between 5%, how would I use it on the spread?
It's not cut and dry. You're allowed to kind of use your judgment as to the extent of, is this truly a small dividend? If we have 200 million shares out there and I issue 20% of that, does it have as big an impact as if I had 5 shares and I issued 3 more? That's a big deal. To me, in my mind, it has more of a direct impact, I think. But all right, here's another fun thing that they do. Anybody ever heard of a stock split? So this is where they come along and they say, we're going to split the stock. So if you own a share, we're now going to take that one back and we're going to issue you 2 new ones, the new stock, okay? Or we're going to issue you 3 new ones or 4 new ones, okay? Sometimes they'll do it what's called a reverse stock split, and they'll say instead of, for every 1 share you turn in, we're going to issue you half of a new share. The whole point here is a lot of people believe or try and manage their stock price on the market within a certain target range. Let me give you an example. If a stock is trading at $20 a share, you could maybe buy a share of it, right? If that same stock is trading at $200 a share, you might not buy it, right? So a lot of companies will try and maintain their stock price between, say, 20 and $50 so that more people can have access to it. Some companies don't believe in this. If you watch what happened with Apple, Apple's never done the stock split, and their shares went into the $500 range, right? Why not do a 5-for-1 split and drive the price down to $100? They don't believe in it. So the thing you need to realize is after the stock split, your value per share drops, typically by the correct percentage, par value also drops. So in this example, it's a 2-for-1 split. There's 3,000 shares outstanding of $2 par common stock and a 2-for-1 split. 2-for-1, I go from 3,000 to 6,000 shares, right? My $2 par value goes to $1, goes in half. And my total par value, does it change? No, not at all. You theoretically on the market, if this was selling for $20 a share on the market, they now would sell for 10, ballpark, okay? So the value per share went down, but in total, you have the same number of dollars because you have twice as many shares, okay?
How would you, like some companies, they do 1 cent par value.
Right. It's now worth 0.005 cents. Okay, that's part of the problem of a 1 cent par value. It doesn't give you room for this. Yes, ma'am. Yeah. So, other questions?
Yeah.
Yes? No?
Going back to the previous
I don't want to.
slide. How would you record it?
Oh, I think we're going to get to that. If we don't, we'll do it at the end, okay? I promise. Don't let me forget. Yes, ma'am.
So why would a company choose to do either stock dividends or stock splits?
Have I given you something as a shareholder? I gave you more shares. Have I given up my cash? That's the trade-off. So if I'm a company that, all my shareholders are used to getting some sort of a dividend, and all of a sudden I have a bad year and I can't really pay one out, I got a trick. Or if I want to keep the cash and reinvest it in the company because we're going to buy a new building or something like that, let's go do it. Yeah. Okay. Preferred stock. Remember we talked about common stock and preferred stock. Preferred stock comes with different rights than the common stock. And again, it's just an investment or a financing vehicle for the company. Preferred stock, typically, sometimes they do, but almost very rarely they have voting rights. Most of the time they do not have the right to vote. So it's kind of like bond ownership. If you bought bonds in a company, can you go to the board meeting and vote? No. Or the shareholders meeting and vote? No. But the trade-off is, in exchange for having to keep silent, you get a fixed dividend rate. They promise you that every year you're going to get a 6% dividend. So typically with a preferred stock, it'll have a par value. It won't be a penny. It'll be $10, $50, $100, whatever the number is, it'll have a par value. And you're guaranteed, say, a 6% return or an 8% return or a 3% return every year on that. Okay?
What do they do the stock split?
Typically, you don't declare a stock split on this. Because it's much more of a financing function. It's much more of a borrowing than just selling of stock. And that's how it behaves. Okay?
And then those preferred stocks tradable as well?
Yeah, they buy and sell on an exchange all day long. Okay? And sometimes you'll see preferred shares A, preferred shares B, preferred shares C, and they're issued at different times, and they may have different rights. One may be at $10 per share, 6%. One may be $100 per share, 3%. You'll get different things all the time. Okay? So you got to know which one you're buying or selling, because they will trade at different values. Yes, ma'am.
Do companies usually offer this preferred stock option to employee?
No.
No.
No. Typically, stock options are the common shares. If any of you ever see one that's not, let me know. But, I mean, it could happen. But, yeah. Yes?
What option is it? You don't actually have the shares, you just have the option to buy them.
An option means that you have the right to buy a share at some future point in time at a preset price. You can exercise the option and then you own the share. But if you just have an option, you have no right to vote. nor do you have a right to a dividend or anything like that. Okay? Okay. Dividends on preferred stock. So just think about the name, preferred stock. They get preference to the dividends, if any are declared. They get paid first. And then there's two different things that can go on. There can be a cumulative preferred stock, and on cumulative, what that means is, say you're guaranteed a 6% return. Say it's $100 par value, 6%. You're guaranteed $6 a year, right? If it's cumulative, say in 2012 the company didn't declare dividends. They had a bad year. In 2013 they declare a dividend. You get last year's $6 and you get this year's $6 before anybody else gets any money. Before the common stockholders get any money. If it's not cumulative and they didn't declare a dividend last year, it's lost, it's gone. So that's a different level of rights to the stock. Okay?
So is current before cumulative?
Well, on preferred stock, you get current dividend preference, period. You get paid first before the common. If you get cumulative dividend preference, you get last year's and this year's. Or how many ever years are in what are called arrears. We didn't pay a dividend last year or the year before. You get paid those first before anybody else gets, okay? So that's cumulative, and the other is just preference. They both have preference. One you get to make up last year's and the other you don't.
So that fine print, you pay attention to?
Pay attention to the fine print. You want this one, right? Now this thing is really behaving like it's an interest payment, right? Really, really. And a lot of times preferred stock will have a conversion feature. You know, if the company's not doing well and we're not declaring dividend year after year after year, you can convert this to common stock at some preset ratio, and then you have a right to vote. So sometimes there'll be that conversion feature in the preferred shares. Okay? So if it's not cumulative, non-cumulative, dividends that aren't paid are lost. They're gone. If it's cumulative, you get to pick those up in future years. Everybody understand? Good? Nodding of the head, yes. Okay. So I want to do an example, because this can get a little complicated. It looks complicated until you do a few. So let's do a few. Okay? In this example, they've got a common stock that's $1 par. No big deal. There's 100,000 shares. They've got some preferred stock. It's a 3%, right? That guaranteed amount. $100 par. This one's cumulative. 5,000 shares. Notice there's a lot more data here. 3%, $100 par, cumulative, 5,000 shares. Then we've got another type of preferred stock B. It's 6%. $50 par, not cumulative, 3,000 shares outstanding. Notice that the not cumulative pays a higher guaranteed dividend rate, right? So if they paid the same dividend rate, you would buy this one instead. So they give you a little risk-reward opportunity here. You're taking the risk that some years you might not get it, but you get paid more. Dividends were not paid last year. What does that mean for the non-cumulative guy? Last year's gone. The cumulative guy, he gets last year's and he gets this year's. Okay? The board of directors declared dividends of $50,000. Who gets how much? Good? Questions? All right, here we go. So, we start with the cumulative guy first, because he gets last year. So, we owe him for last year. It's $100 par value times 3%. $3 a share times 5,000 shares. $15,000 go to those guys for last year. Good? Then they get this year's. $100 times 3% times 5,000 shares. Another $15,000 this year. They were guaranteed that 3% rate. So right off the top of the 50 grand, 30,000 goes to what we'll call the preferred A shares, the cumulative shares. Everybody with me? Then we go to the preferred B shares, the non-cumulative guys. They've got a $50 par at 6%. That's $3 a share also, right? 3,000 shares, they get $9,000 for this year. Do they get anything for last year? No. Non-cumulative. It's gone. They lost it. So, 50,000 less 30 less 9 leaves $11,000. The $11,000 goes to the common shareholders. Divide by the number of shares, you figure out how much per share. Okay? Yes, sir.
So you come down to preferred stock, non-cumulative, and that takes all the remainder, then common stockholders would not receive anything, correct?
That's a great question. So let me just change the numbers and I'm going to make it easy. If these guys got 30 grand and the preferred non-cumulative got 20 grand and there was 0 left, common stockholders get bubkiss. Okay? And that can happen. If you go a lot of years in arrears, these guys will suck it all up.
Just follow up on preferred stock, and I say there's less than $150 par, do they just get a pro rata then?
Yes. So, these guys will get all the years in arrears. Whatever's left, you're going to split between these two guys pro rata. Okay? And then you come down here, these guys get 0. Yes, ma'am.
Why is the par value different for the preferred stock and for the common stock? And then different from each other?
Okay, there's a reason for that. Remember, the preferred shares are much more of a financing loan type structure. Almost like a bond. The 3% functions off of the par value. So if this was a $1 par value at 3%, they'd be getting 3 cents a share. Right? So I'm just going to issue fewer shares for a higher dollar amount to get more money for fewer shares. Okay?
Is it the same, like if they issue preferred stock, like preferred stock, at different times? Is it always
Right.
that same par value, or do they change the par value?
No,
If
if I have a preferred issue, this is preferred issue A, preferred issue B. If I have a preferred issue C, it could be something else and a different interest rate, and they can all be completely independent of each other. Okay? Okay. Here, another thing that I should point out. What? I know. Some of these are funny. I kind of look at them and go, huh? If you go and borrow money from a bank, a lot of times the bank will put what are called covenants on the loan. And covenant is just an agreement. I will lend you the money, but you're going to maintain a current ratio greater than X. You're going to not declare any dividends until I get paid back first. So they kind of put these restrictions on you. So sometimes companies will not be declaring dividends because they've got a loan that says they can't until the lender's paid off first. Okay? Just a thought. All right. A little more conversation about cash flows as we're getting closer to chapter 13. Remember, issuing stock is a financing activity, right? We're borrowing money from the general public to start our company, to run the company. You sell stock, your cash goes which way? Up. I'm giving them stock in exchange for their money. If I buy back Treasury stock, cash goes which way? Down. If I sell the Treasury stock, cash goes which way? Back up. If I pay dividends in cash, as opposed to a stock split right? Cash goes which way? Down. Good? Okay. We're going to stop there.